A couple thoughts about regulation and how regulations contributed to the bubble in the subprime market. And the first regulation to contribute was something called fair lending, which was supposed to eliminate racial discrimination in the banking business. I joined BB&T in 1971. By that time, frankly, there was no racial discrimination because every bank was trying to make money and you wanted to make all the good loans you can make. Unfortunately, however, right before Bill Clinton got elected the first time, the Federal Reserve of Boston did a research study, and some Federal Reserve studies are good, some are not so good. This one was terrible. The research study concluded there was a lot of racial discrimination in the industry. Turns out the study has now been totally discredited. It was I called it a childish study. It only looked at debt to income ratios and it didn't consider the reliability of the income. It didn't consider collateral. It didn't look at past payment history, character type issues. Nobody would have made a loan based on the standards that they use. And of course now the Fed itself has discredited the study. But when Clinton got elected, he was absolutely convinced there was racial discrimination. He had a huge political debt to the African American community that had got him elected, and he was really energized about this, both over ethical and political reasons. So basically a dictate came out, and the theory was the banking examiners had missed the racial discrimination, let's go find banks guilty. And they did that systematically. I talked to a lot of CEOs that got found guilty. No, they all said, no, we didn't do racial discrimination. However, it was easier just to pay this small fine and change these systems and then let them put out a press release that we were guilty of discrimination, and that made, quote, everybody happy. Well, they came to BB&T, and we didn't operate that way. They came to me and said we were guilty of racial discrimination. I said, well, if that's so, that's against our fundamental ethics. Give me the names of the people that are discriminated. I'm going to go fire them now. I'll do it personally. They said, oh, no, nobody discriminated. Okay. I said, how about a system? We have a system or process that causes discrimination. Oh, no, it just happened magically. So we said, okay, let's get your evidence. We looked at the evidence, and basically they had these loans that we'd made, not made. And what we determined, and what the safety and soundness examiners, by the way, determined, is every loan we made, we should have made, and every loan we turned down, we should have turned down. There was no racial discrimination. Now, we were still advised to go ahead and admit it, because if we admitted it, we'd pay a fall fine and move on. We said no. They stopped our mergers and acquisitions for months. We had several in process that never materialized. We were ready to go to court. It may have been dumb, but we were ready to go to court. And then a very interesting thing happened, which will tell you a lot about the rule of law. Newt Gingrich and Republicans got elected 2 years into Bill Clinton's term. Guess what the regulators did? The Republicans were elected on Tuesday. On Thursday, they all went home. We never heard from them again. True story. True story. Happened again recently, last year, Obama administration, more energy on fair lending again. They accused us of discriminating on 13 loans. Now, BB&T has millions of loans, 13 loans where we were supposed to have charged higher interest rates on minority borrowers. We looked at the facts, and here's the interesting fact. Yes, the interest rate were higher, but the actual what's called the annual percentage rate was less. The government makes you compute. We spend hundreds of millions of dollars in the industry computing what's called APRs that are supposed to reflect the real cost of the industry. The minorities were getting a better deal. They still said that was discrimination. They sent it to the Justice Department. Well, of course, what had happened is that our lenders were trying to help these low-income minority borrowers and help them refinance so they could cut their payments. But the borrowers didn't have the cash to pay the front-end fees. So they cut the fees and charged a little higher rate, and they helped the borrowers who were a lot better off. That's, quote, discrimination. Went to the Justice Department, didn't hear anything for months. November 2010, the Republicans get elected again. 2 weeks later, we get notification to the Justice Department they're not going to pursue it. Now, I don't know if it's connected or not, but it's just an interesting. Fair lending was the beginning of the affordable housing effort. Another big factor psychologically, not mathematically, was the Community Reinvestment Act. We're supposed to eliminate redlining in the banking industry. Community Reinvestment Act, while the numbers weren't significant, the psychological effect was huge. What banks were forced to get into the low-income lending business, and banks are not designed to be low-income lenders. We're not consumer finance operations. And we were forced to do that on a fairly large scale. Interestingly enough, people wonder why Standard & Poor's, Moody's, and Fitch made such bad ratings to subprime mortgages. What happened to them, and I don't justify what they did, they used the CRA loss ratios and assumed those were normal. Well, what was going on when the CRA was really kicking in? Housing prices were appreciating very rapidly. So we were having fairly high failure rates, but we weren't losing any money because the prices were going up, right? In addition, this is a mathematical thing. If your portfolio is growing very fast, it looks like your losses are a lot lower than they are. The losses catch up with the portfolio. So Standard & Poor's, Moody's, and Fitch used these bank CRA ratios and made very bad loss assumptions in the subprime lending business. And finally, and this is non-trivial, CRA was a moral crusade. Bankers were supposed to do low-income lending. And I know there's a lot of greed and crazy stuff on Wall Street, but when you combine this is the right thing to do and you make a bunch of money doing it, you create a huge incentive. And CRA lending now is viewed bad, but it was viewed as a moral code to do. Another interesting thing, one of the myths out there is that the banking industry was deregulated during the Bush administration. Nothing can be further from the truth. We were grossly misregulated. There were three major regulatory programs during the Bush administration. First was the Privacy Act, where we send hundreds of millions of notices to our clients about privacy, and fortunately nobody's dumb enough to read them. Complete waste of time. The second was Sarbanes Oxley. Now the banking industry had already had a Sarbanes Oxley back in the 90s because of the failure of the thrift industry. This was a redundant system on a redundant system, tremendous waste of time, energy, and focus, and very scary, by the way, very threatening. And then was the Patriot Act. The Patriot Act is where we're supposed to catch terrorists. I've talked to a number of people in government, and they all do this dance act, but the truth is there's never been a single terrorist caught and convicted because of the Patriot Act. Not a single one. The industry spends $5 billion. And I would argue nobody's going to be caught, because if you're dumb enough to get caught on the Patriot Act, you're so dumb you don't get caught anyway. What's interesting about the Patriot Act, the only significant conviction on the Patriot Act is Elliot Spitzer, the governor of New York, was convicted of soliciting prostitutes. Now, in a way, that's just because Elliot Spitzer's a really bad guy. But in a way, those of you that are libertarians ought to be scared to death. What would be the basis of pursuing a governor of a state for prostitution and law theoretically designed to eliminate terrorists? It's a really bad law. Let me tell you, the effect on this, and I'll tell you this personally, and this was the Federal Reserve on us, was the intense focus from the regulators on, particularly on Sarbanes Oxley and the Patriot Act, misdirected management focus dramatically in our organization. They were threatening to do bad things to the board, fire management, maybe even put us in jail. It impacted our behavior radically and made us put a lot less focus on traditional risk management. And I guarantee that happened in the whole industry. The industry was not deregulated. It was massively misregulated. One summary thought about regulations and one other big aspect of regulation. The cost of regulation is huge. Yeah, in fact, if you ask me, would I rather eliminate taxes for banks or eliminate regulations? It's a no-brainer, regulations. BB&T alone has added 1,000 people on the regulatory stuff in the last year. And of course, what we've done is reduce production because we couldn't afford to add 1,000 people. We'd shift people out from production into regulation. Secondly, the mental price is high. You can only do so many things. And if you're trying to make some regulatory person happy, instead of being productive, creative, and innovative, you become less of a creative, productive person. That's just a fact. Comment on safety and soundness regulation. First, in my career, I do not know of a single case where the regulators identified a significant financial institution problem in advance before the market knew it. Now, I know they've gotten involved a lot of times, and when they've gotten involved, my feeling from talking to the management, most of the times they made the problem worse, not better. And I don't view the regulators as actually stopping problems from happening. And why is that? Those of you that study public choice theory, this should not surprise you at all. In the good times, the regulators always under-regulate. Give you an example. BB&T took over a failed financial institution called Colonial. It was a big company, $25 billion company, and we only did it because we got FDIC insistence on the credit risk. We had been following Colonial for 15 years. BB&T did lots of mergers and acquisitions in my career, and Colonial fit in our acquisition bucket, and so I'd been following the company for 15 years. We consciously chose not to buy the company without the government assistance. Why was that? First, they were rolling up lots of crummy banks in Florida, and if you roll up a lot of crummy banks, you end up with a big crummy bank. Secondly, they were making lots of big, high-risk real estate loans we saw in competition with them, and a lot of their revenues were coming in that. And thirdly, we met the CEO, and the CEO was a maniac in terms of his mental processes. He was very arrogant. He had an airplane that could probably hold 30 people, and he'd personally fly from Mobile to Birmingham in the airplane. He couldn't have any middle management. He had good people in his branches. We looked at this company, and we said, these guys are going broke someday. This is outside, no special, and we're not going to buy them. They're going broke. Examiners did not identify that problem. Why not? First, probably the examiners in there hadn't joined the agency until 1995. They've never seen bad times. The 2000 correction was a very minimalistic correction in the banking industry, so they'd never seen bad times. And even if they couldn't even see that they had problems. They didn't understand the business. And if they had, what would they have done? Probably nothing. Why is that? This CEO had huge political clout. He was connected to the governor, the senators. If they had started problems, he'd have gone to the politicians and they'd brought heat on the agency. And why do that? I'm going to rotate in 5 years. Why take that chance? Why take the chance? So under regulation in good times. Now, they can do, if Bush is energized about the Patriot Act, they can do that because they got political support for that. But under regulation of safety and soundness. How about in the bad times? And this has happened every time we've had a correction in my career. It happened in the early 80s, it happened in spades in the early 90s, and it's the worst this time. The regulators inevitably, irrationally tighten lending standards, including financial institutions that have good credit histories. They did that at BB&T. They tightened our lender standards dramatically. Today, BB&T didn't make loans that we would have made if it were not for the regulatory process, and we put people out of business that we wouldn't have put out of business if it weren't for the regulatory process.